When you lose, let's say 25% or more in the stock market, do you know what it's going to take for you to get back to par value in your portfolio? Well, I will absolutely tell you that many consumers do not understand the math around the stock market recovery. And so we're going to talk about that in this video today because I think it's very, very important to your overall retirement understanding. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And our goal for making these educational videos is to help make the difficult and stressful process of retirement income planning simple.
Yes, and we do this by incorporating our team of expert advisors, ranging from certified financial planners, estate attorneys, insurance advisors, and other needed professionals to help us build a written retirement plan that's going to help our clients understand when, where, and how to take money from their retirement savings.
For the best retirement income planning advice, please subscribe to our YouTube channel and hit the notifications bell to be notified when we upload new videos.
So Andrea, as nice as it would be to get a notification bell on when the next stock market crash is going to happen, that's really just not reality. Market downturns are a normal part of the stock market cycle, and they can happen for many different reasons. But it's very important that you as a consumer can remain educated about when a market downturn takes place. Because when that happens, two of the most common emotions are always preyed upon by a lot of people out there, and that's fear and greed. So history clearly shows us that the stock market is going to crash at some point. But that same history will also tell us that it's going to recover as well. But what I want to show you in this actual educational video today is how long will it take for you to get back to even and what it's going to take for you to get there. But before we do that, there are always two rules to retirement income planning that we want to share with you. And what are those two rules, Andrew?
Rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
So let's talk about first what exactly is a stock market crash. So let's now talk about the difference between a correction and a bear market. So I know this is a question that a lot of people have, but a correction is defined as a 10% or more decline in one of the major U.S. stock indexes, typically the S&P 500 or the Dow Jones Industrial Average, from its recent 52-week high. The average recovery time from a correction since World War II has been approximately 4 months. When we enter a bear market, that is going to be defined as a drop of 20% or more from a high in one of the major U.S. stock indexes. And the average recovery time since World War II has been about 2 years from a bear market. Now, we did have a really unique situation in 2007 to 2009, the financial crisis, when the stock market dropped 57%, and it took more than 4 years to fully recover. And just for a little fun fact, it took 25 years for the market to fully recover after the 1929 market crash. That's pretty astounding.
So just to summarize, Carson, what you're saying is that a stock market correction is a 10% or more drop from the market highs, and a bear market is a 20% or more from the market highs?
Absolutely. So a 10% more correction is a 10% more drop in the stock market is a correction. A 20% more drop in the stock market is what we call bear market territory. So let's continue with our education on the math of what it's going to take for you to recover when there is a major stock market drop. Now let's talk about the math of recovering from a stock market crash. This is really critical for you to understand because a lot of people don't understand the math when it comes to when they lose money in their stock portfolios. So if your investment goes down by a certain amount, it's going to take approximately how much for you to get back to zero, back to par? Well, if your investment's lost 10%, it's going to take approximately 11.1% for you just to get back to zero. If it went down 20%, the math indicates that it's going to take about 25% for you to get back to par. If you lost 30%, it's going to take you a little over 42% in order to get back to even. If you went down 40%, it's going to take you almost 67% in order to get back to even. And if you dropped a whopping 50%, like we saw in 2007 to 2009 in your portfolio, you're going to have to make 100% return in order to get back to even. So you can clearly see this is not a fair fight. This is why we encourage our clients and always advise them on the importance of protecting their money as they get closer and closer to retirement. Now, what we want to talk about is your recovery rate. We're going to take a look at this chart, and you can see we have hypothetical interest rates of 3, 5, 7, and 9%. We want to know how many years would it take for you to recover your money at these different particular interest rates. So if you lost 20% and decided to go conservative, it's going to take you almost 7.5 years in order to get back to zero. If you can, of course, stomach to be a little bit more aggressive, that time is going to be literally almost cut in half. But let's take some of the extreme measures that we've seen here recently. During the pandemic, the market dropped over 30%. If you decided to pull out and go very conservative, it's going to take you over 12 years to recover your money. And if you look at what happened during the financial crisis of 2007 to 2009, when the market dropped over 57%, if you decided to pull out like many retirees did because they were afraid, it's going to take you almost 24 years at 3% to recover those dollars. That is why we saw so many people who were retired having to go back to work again because they had lost so much of their financial savings and they just could not stomach leaving that money into the marketplace in order to recover, which was really important that they did so. So it's important for you to understand these measures. So I hope that this educational video was very informational to you. We want you to leave any comments or questions that you have in the comments section below, and please subscribe to our YouTube channel.
To learn more about our services on how we can help you to increase your chances of not outliving your retirement savings, make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, check out our other videos that we created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching. And remember, if you have questions,
we have answers.